So in our opinion, I think we're on a path to inflation. So inflation is the mirror image of reflation, which, with the exception of, it is a risk-off regime. So if you think about like what asset markets are trying to price in when they pivot to a reflation regime, they're effectively saying nominal economic growth is going to accelerate, or it's just going to come in above trend, and there's no policy support to push back against that. What reflation's, kind of at least redheaded stepchild cousin, what that's pricing in is effectively the same conditions on nominal growth, but they're effectively saying, okay, now we have to be worried about fiscal or monetary policymakers taking away the punch bowl. And the taking away of the punch bowl is something that we very much expect in and around mid-year.
Darius Dale, founder and CEO of 42 Macro. It is so great to welcome you back on the show, and great to see you again, Darius. Thanks for taking the time.
Yeah, it's a pleasure. Thank you for having me, Julia. How you doing?
I'm doing great, and we're thrilled to have you back on, and you're always a hit with the audience, and lots transpired since we last had you, which I think was back in October. So Darius, let's kick things off with the big picture macro view. Where are we today within your framework?
Yeah, great question. So it's a great day to have me on. I was actually just liaisoning with our institutional client base, talking about the market regime pivot that we observed vis-a-vis our primary risk management system into reflation this morning. Recall that we have been in Goldilocks, and we at 42 Macro have been calling for Goldilocks since around mid-November. In terms of that, that reflation is a different set of market regime rules as it relates to your portfolio construction. Obviously, you're going to be incrementally less exposed to defensive assets and incrementally more exposed to risk assets at the margins. You're going to want to be underweighting, bond proxies and really core defensives in the equity market in lieu of, cyclicals, higher beta type exposures. This may be, finally what everyone's been hoping to see for all those who have not participated in Goldilocks, which is a potential breakout in small and mid caps relative to mega caps and a broadening out of participation. So those are the kinds of things investors can expect in a reflation regime. We can unpack a little bit more detail what's causing that regime transition and ultimately the sustainability of this new reflation regime.
Let's do that. I want to hear more on the regime and the drivers of it. Let's go there.
Yeah, absolutely. So for those of you who may be relatively new to us here at 42 Macro, we're a regime-oriented macro risk management firm. We service the likes of all the major hedge funds, asset managers, pension funds, et cetera, across global Wall Street. We also have thousands of retail investor clients as well that care about our daily updates in our quantitative risk management system. So we'll fly to the system that signaled that we were in reflation today, which is our global macro risk matrix. We use this to nowcast what we call the top-down market regime, which is the signals that asset markets are sending to investors from the economy to instruct you what to do with your portfolio. Obviously, you need to have some pretty sophisticated quantitative systems that we possess to kind of get that in real time, to ascertain that in real time in order to make the appropriate adjustments to your portfolio to stay on the right side of market risk, right? Like, before we even get into this, the technical aspects of this discussion, Julia, I think it's important to remind investors they have a choice. You don't have to stay on the right side of market risk. You can be long an asset that's drawing down for weeks, months, quarters, even years, if you believe in the long-term fundamental story as a retail investor. If you are a professional investor and you try to do that nonsense at home or your place of business, you will be fired. You will be changing seats. You may not even get your job back in this new AI era. So we built our global macro risk matrix specifically to make sure that our buy-side clients can stay in the seat because they're not drawing down, being long things that they shouldn't be long at the proper time. Or conversely, what we were talking about for the past kind of 4 months is being short things that they shouldn't be short in raging bull markets. Recall that, vis-a-vis our positioning model, we pivoted to that bull run that we saw at the beginning of November last year. So getting back into the technical aspects of this regime phase transition, this system is called our global macro risk matrix. It's not a pretty chart for TV, but it's a very powerful quantitative tool. And how the tool works is it's scoring each of the 42 main markets across global macro vis-a-vis equities, volatility, commodities, currencies, and fixed income rate spreads, et cetera, through the lens of two things. One, our volatility adjusted momentum signal, and two, how the asset has historically performed in each of those regimes. So let's just pick on a particular a market, something that recently occurred. So we had a recent breakout on the 30-year Treasury yield to bullish from the perspective of our volatility adjusted momentum signal. Historically speaking, the 30-year Treasury yield has been bullish in what we call reflation and inflation. Those are the two regimes in which you typically see inflationary biases in asset markets. And so we're doing that same system, that same process daily across each of those 42 markets to ascertain which of those four regimes is actually getting the most love from asset markets at the current juncture. And today, reflation became the dominant regime. It now has 36% of the total amount of signal that global markets are generating for investors at this moment. So what does that mean? Reflation, as I mentioned, is risk on with an inflationary bias. You think about what risk on means. Obviously, risk on typically means asset markets are performing quite well. And then from a factor selection standpoint, we're thinking about this from the perspective of more incrementally more bearish on defensive assets like treasuries, gold. Those things tend to do really quite negatively in reflation, and incrementally more positive on things like cyclicals, mid cap, small and mid cap type stocks relative to mega cap stocks, relative to defensive stocks. Those are kind of the main pivots you're going to be making in reflation. But generally speaking, everything else transitioning from Goldilocks to reflation is pretty much the same.
Okay. You mentioned the reflation dominant regime that we're in, risk on with an inflationary bias. Can we hear a bit more on like the inflation side of things in this regime?
Yeah, absolutely. So the question is, whenever you pivot to a new regime, and again, there's about 3 regime pivots. There's about 3 what we call row phase transitions per year, where you're going from a risk on regime to a risk off regime, or you're going from a risk off regime to a risk on regime. There's only, empirically, there's been about 3 of those per year, whether you look at it on a trailing 5, 10, 20, 30-year, basis. It's pretty consistent. Actually, I'll just show you a quick chart on that before we move on. If you just look at the frequency of the row transitions, we've had 4 over the past year, but over the last 3 years, 3 on average, 5 years, 3 on average, over the last 10 years, 3 on average, over the last 20 years, 3 on average. So we can expect, these types of, this is not a row phase transition, by the way. We're going from Goldilocks to reflation. Those are both risk on regimes. So you don't really have to do much as an investor to stay on the right side of market risk. You have to do a lot as an investor to stay on the right side of market risk when in fact you are row-ing, which is, again, it's not what's happening currently. But in terms of what's actually driving this phase transition towards reflation, in our opinion, it's a combination of a couple things. One, asset market investors are getting increasingly comfortable with the sustainability of the above trend nominal GDP environment we've been investing in really since the start of the fiscal and monetary response to the pandemic began in the spring of 2020. That's something, in our opinion, we're seeing investors kind of take share from the perspective of the soft landing scenario and allocate incremental units of their mind share to a no landing scenario. I don't think that process is complete, but by the time this reflation regime peaks, and we're well off of a peak in the reflation regime right now, we only have 13 asset markets confirming it. Over the last 3 years, the peak of that was 32%. Over the last 3 years, the peak in terms of the share of those total markets was 50%. We're only at 36% now. So we can get a lot more reflation-y. And by the time we get to the peak reflation, in our opinion, we think a few things will be a little bit more true in the minds of investors. One thing that'll be more true in the minds of investors is the stickiness of inflation. I don't believe that we are in a really negative standpoint, really negative setup from the perspective of observing and interpreting incremental inflation data for the next, let's call it, quarter or two. But I do believe by the end of this reflation regime, asset market and market participants broadly will be quite concerned about the sustainability of the immaculate disinflation theme that has really supported the preceding Goldilocks regime. So let me just quickly break down some of the most recent inflation data. We got obviously CPI and PPI last week. Just to highlight a few statistics in the CPI report, we saw headline CPI accelerated to 2.8% 3-month annualized. That number's above trend. We saw core CPI accelerate to 3.9% 3-month annualized. That number's above trend as well. We saw core services and shelter inflation accelerated to 6.6% 3-month annualized, respectively. Those numbers are well above trend. We saw super core CPI, which is core services ex housing, accelerate to 6.5% 3-month annualized. That number's well above trend. And then lastly, median CPI and trend mean CPI accelerated to 5.2% and 4.1% respectively 3-month annualized. Those numbers are well above trend as well. So on the CPI statistics, we are starting to see pretty obvious evidence of what we call sticky inflation. And sticky inflation, for those following along at home, just means that inflation is not going to go back to 2% because policy is unlikely to be tight enough. and or we have not had enough economic and particularly labor market deterioration to really promote that outcome. I don't believe, again, as I mentioned earlier, that we're done with this immaculate disinflation thing, because there's been a pretty significant divergence between CPI statistics in recent months and PCE deflator statistics in recent months. And we, based on our analysis, expect that divergence to persist for another 1 to 2 quarters. And if that's the case, if we persist in that divergence for another 1 to 2 quarters, asset markets can celebrate what this nominal above trend or above expectations nominal GDP environment can be. But at some point, they're going to go, well, we can't just hang out, well above trend or well above expectations from a nominal GDP perspective forever, because ultimately it just means the Fed's not going to be successful in getting inflation sustainably back to 2%. But for now, they are getting a lot of good news, as Steve Powell mentioned a few weeks ago in the FOMC, at 3-month annualized core PCs at 1.5%, 6-month annualized at 1.9%. Those numbers are dragging the year-over-year down over the next quarter or two. If you look at super core PCE, 3-month annualized at 2.1%, 6-month annualized at 2.7%, and those numbers will drag the year-over-year number down towards that over the next quarter or two as well. So we have a decent amount of confidence, as I mentioned, that inflation's kind of still behaving, but in a quarter or two, it's very likely that, at least according to our models, that inflation will be misbehaving by the time we get into the mid-year.
Hey there, I hope that you are enjoying this interview. If you can, please take a moment to hit the like button, subscribe to the channel, and ring the notification bell. This will keep you up to date with all of our new interviews, and it will also help us grow this channel and continue to bring some amazing guests. Thank you so much for your support, and enjoy the rest of the interview. And speaking of the FOMC, I imagine, Darius, clients ask you about the Fed and interest rate policy. What is kind of your take or your viewpoint as relates to the Fed and cuts, if those will be coming, or if it's still higher for longer? I had a guest who even suggested that we might actually see a rate hike. So I'm curious, like, your perspective on the FOMC and interest rate policy.
Yeah, I mean, look, you got to really tip your cap to former Treasury Secretary Larry Summers, who kind of got the incremental rate hike party started last week with his comments on Bloomberg Wall Street Week. He's been a great voice, in terms of, he's been a great Fed watcher, particularly over the last few years, in terms of kind of being one of the first loud voices to really call for accelerated policy tightening relative to what was priced in, and then really calling for higher for longer, and helping investors understand that the kind of the dynamics in the economy that have changed on the fiscal policy side and really on this labor supply side. He amongst myself, we certainly been attributed a lot to that discussion as well. He's been one of those folks alongside ourselves that's really helped investors understand that higher for longer is a likely outcome. With respect to Fed policy. Going back to the rate cuts, this discussion around rate cuts, Julia, I think it's very important to remind investors that the rate cuts already happened. I think it's, we think about rate cuts, like the average investor is trained to believe rate cuts are only going to happen when the Fed starts lowering the policy rate. But the reality is asset markets, the U.S. economy, broader major economies function on market conditions, on financial conditions. They don't function on the observed level of the policy rate. That has very little impact for broader financial conditions. And so what I'm showing in this chart here is the policy rates for the Fed, the ECB, the Bank of England, and the Bank of Japan. And the blue line in these charts show the 3-month overnight index swap rate for that particular currency minus that policy rate. So effectively what's priced in from a rate hike or rate cut perspective over the next 3 months. The red line shows the 6-month, the purple line shows the 9-month, and then the green line shows the 1 year. And as you can see, we've been basically negative for most of these really for the past 6 months or so. And it got deeply negative heading into the nadir that we saw across the policy or these OIS spreads in January. So from our perspective, the rate cuts already happened. And now over the next quarter or two, we're going to be dealing with the lagged impact of this financial conditions easing vis-a-vis the data. This is why we are having an expectation that nominal and real economic growth are likely to continue surprising to the upside, over the next, at least quarter or two, based on our data. And if you recall, I'm not sure if we talked about this last time I was on, but I credit 42 Macro myself as authoring the Resilient U.S. Economy call back in the summer of 2022. We've been consistently espousing, kind of that research as supportive of broader asset markets, at least, so from January of 2023 onward. more importantly, as sort of supportive of or as a rejecting the hypothesis that the Fed has to quickly return to a kind of quote unquote kind of neutral or easy monetary policy setting. One thing I call out going back to sort of the rate cuts that have quote unquote already happened, at least according to us. We show this chart here where we show the hyperfinancialization of the U.S. economy, and what we mean by that is that a lot of credit that is created in the U.S. economy relative to other economies tends to be credit that's created by non-bank financial market participants. So, most economies, if you look at an economy like China, where 85% of private non-financial sector credit is on bank balance sheet, or even in Japan, where 67% of private non-financial sector debt is on bank balance sheet, those numbers are way higher than what we're observing here in the U.S. at 33%, which means 67% of the credit, the private non-financial sector debt in the U.S. economy is not on bank balance sheet. It's on the balance sheet of the buy side. It's on the balance sheet of the insurance players. It's on the balance sheet of the pension funds. It's on the balance sheet of mom and pop retail investors. And so when market conditions get good, i.e. rate cuts get priced into money market curves and all throughout the treasury curve, and or volatility goes down, credit spreads tighten, volatility in fixed income and currency markets goes down, and liquidity goes up, as it has been. We can talk about that in a second. That's when you tend to see economic growth, surprise to the upside. That's when you tend to see firming of inflation, and that's something we expect to really dominate the data over the next quarter or two.
Yeah, you mentioned liquidity, so I imagine that's part of the liquidity cycle. Where are we within the liquidity cycle?
Yeah, so great question, Julia. So just a kind of the 30,000 foot view on liquidity is that both U.S. and global liquidity have been trending higher since around mid-November, and that's something we called out in real time in our macro weather model. That condition persists to this day. That's obviously a very, very positive setup for asset markets. In terms of what that ultimately means for investors. So this is for those of you who may be new to how we think about investing and how we think about the world. We're very systematic investors here at 42 Macro. We use a series of quantitative tools to help investors understand, where are the risks in the market, what types of factor bets should you be making, the size of those factor bets, the timing with which you are entering and exiting those factor bets. That's all the stuff that we've specialized in here at 42 Macro. We are not, we're never going to be great at competing in the this thing has to crash or this thing has to go to the moon. That's not what we do. I think that stuff's more, it's better for this kind of forum, but it's certainly not for the paid research base. I don't think that's offering much value. But what I think does offer a lot of value is helping investors understand things like where the principal components of macro are headed. And going back to liquidity, which is one of the dominant principal components of macro, particularly from the financial economy side of things, we continue to trend higher from the perspective of 42 Macro net liquidity. We continue to trend higher from the perspective of our global liquidity proxy. Just kind of unpacking, what's kind of driving 42 Macro net liquidity higher. We continue to see this big drawdown in the reverse repo facility balance. And for those of you who are not even aware of this, the 42 Macro net liquidity model is the Fed balance sheet total assets minus the reverse repo facility balance minus the TGA balance. I'm sure you've heard 1,000 investors over the past 2 years come on programs like this and say that's how they think about liquidity. But that's one of the models that we created a couple of years ago to help investors understand some of the dynamics that were hurting that were likely to hurt asset markets in 2022. So you heard it here first, but that's neither here nor there for this particular discussion. For this particular discussion, we want to help investors understand that, hey, we still have $532 billion in the RRP that does not need to be there. The RRP was basically zero for most of the years prior to COVID. Even as long as it's been there, it's been somewhere near zero in terms of its balance. So in our opinion, that money does not need to be there, particularly as if you look at the spread between 5-year nominal treasury yields and minus the RRP rate, we see that the money continues to flow out of the RRP balance because investors are quote unquote locking in yields. They don't want to get spooked by rate cuts that cause them to lose, kind of be forced to. They don't want to be dealing with the reinvestment risk associated with an overnight type instrument. So they're kind of allocating to rates out on the curve. So in our opinion, that's something that is likely to continue over the medium term as Janet Yellen continues to flood the market with T-bills. We have, pretty much if you look on a trailing 12-month basis, I want to say the share of T-bills issued through Q1 of this year is going to be somewhere around 70-ish%, which is way higher than the kind of quote unquote 20% target that the TGA, that the Treasury borrowing advisory committee tends to recommend. But the reality is she can deviate from that recommendation as much and as often and for how long as she wishes. In our opinion, we don't believe that Janet Yellen, whose boss is obviously up for re-election and polling unfavorably in head-to-head polls against its former President Trump, we don't think she's going to do anything to upset the apple cart unless it looks like Donald Trump is going to run away with the election, at which point then I think she can use some of her policy levers like taking up the TGA balance or forcing investors into the RRP vis-a-vis some schemes to really upset the apple cart then. But in my opinion, I don't see any real reason for her to do that now. That's on the U.S. liquidity side. So we expect U.S. liquidity to be favorable for at least another quarter or two. If you think about it from a global liquidity side, our global liquidity proxy, which is the global central bank balance sheet plus global broad money supply plus global FX reserves minus gold, that statistic is actually even a better measure for tracking and understanding asset market performance. This is why we spend most of our time forecasting the different puts and takes and the variables within this particular indicator to understand where is it likely to be. Obviously, a lot of folks spend a lot of time on Twitter saying liquidity this or liquidity that, but the reality is that's a coincident view on liquidity. You need to have a forward-looking view on liquidity if you want to actually make and save money in asset markets, and that's something we specialize in with all of our statistical analysis that we perform here at 42 Macro. But just one quick thing on liquidity. The liquidity impulse is appreciably positive if you look at the trailing 3-month delta over the past couple of months. It's about, not as positive as it was at the beginning of 2023, but pretty positive relative to the longer term time series. And then secondarily, a lot of that liquidity is coming from the explosion in the PBOC's balance sheet. Explosion in PBOC's balance sheet is primarily coming from claims on banks. So think about incremental overnight, so 7-day repos and medium-term lending. It's coming from things like pledged supplemental lending. That's up as well. So China's panic to stave off deflation in their market is definitely something that has contributed to positive global liquidity in recent months, really since going back to kind of sort of October, November, and that's something we would expect to continue for at least another quarter. So things that kind of summarizing this, reflation is now the market regime. Reflation is incrementally bearish for defensive assets relative to risk assets. It's incrementally more favorable for cyclicals relative to defensives, incrementally more favorable for small and mid caps relative to mega caps, and it may cause the broadening out of performance that a lot of investors are hoping to see because they didn't get the call to get long risk assets back at the beginning of November from 42 Macro when we issued that call to our clients.
Yeah. And I think you may have just kind of answered it right there, but on this reflation market regime, understanding the benefits, I imagine there are drawbacks to it as well, and also understanding it within the context of existing economic conditions. How do you kind of frame that up?
Yeah, 100%. So in our opinion, I think we're on a path to inflation. So inflation is the mirror image of reflation, which with the exception of it is a risk-off regime. So if you think about what asset markets are trying to price in when they pivot to a reflation regime, they're effectively saying nominal economic growth is going to accelerate or it's just going to come in above trend and there's no policy support to push back against that. What reflation's kind of ugly red-headed stepchild cousin. What that's pricing in is effectively the same conditions on nominal growth, but they're effectively saying, okay, now we have to be worried about fiscal or monetary policymakers taking away the punch bowl. And the taking away of the punch bowl is something that we very much expect in and around mid-year because it may become clear by then that the PCE deflator statistics are no longer behaving in an immaculate disinflation manner, that they're starting to behave more like what the CPI statistics are behaving like currently. That's one thing that could cause that transition from reflation to risk on reflation to risk off inflation. Let's call it around mid-year. We also get the productivity data in the beginning of May to potentially signal to us that what's caused a lot of the soft landing, what's caused the probability of a soft landing to elevate and become the modal outcome expectation amongst most investors, which obviously has really underpinned this Goldilocks regime we've seen since November. If we got a negative productivity report, that could obviously cause investors to really think about, okay, the pressure back on corporate margins is back on. If the pressure back on corporate margins is back on, then we have to consider either incremental, rounds of price hikes, from corporations to consumers, or we have to consider incremental deterioration in the labor market in terms of the corporations trying to protect margins. So, we've gotten the sort of nice productivity benefit for the past couple of quarters in terms of the data, and based on our analysis of some of the, I wouldn't say leading indicators, because we economists don't really know what causes productivity. We have theories, but nothing really statistically significant. But in terms of how we just how we think about productivity here at 42 Macro, some of the things that are potentially causing that, which are lower labor turnover, obviously the development of the AI infrastructure and around that, and above trend fiscal spending, all these types of things, create excess units of demand in the economy that could create a boom of productivity, and also knowledge, reduced kind of knowledge. I don't know what the word for this is, but lower turnover obviously means that your employees are likely to be more productive, because the training that you are, kind of spending time with them is actually going to create positive outcomes for your business. All those things, in our opinion, are things that are somewhat sustainable, particularly on the AI front, but may not be sustained, because again, we don't really know as economists what truly causes productivity to be above or below trend for extended periods of time. We could just go back and look and say, okay, it was probably this, probably that. And so that's kind of the best we can do as economists in terms of the literature there. So kind of wrapping up, it's very much likely that we're not going to get any real negative data shocks, to the immaculate disinflation narrative. Really, any real negative shocks to the resilient U.S. economy narrative. Oh, I forgot to mention at the beginning of the program that we have a lot of positive things going on globally as well. One of our themes here at 42 Macro currently is green shoots globally. We're talking about how, if you just kind of look at the matrix of global economic risk vis-a-vis growth, inflation, policy, and the interplay between those three things, on the growth side, we have very clear and obvious green shoots globally. If you look at the deltas, the trending deltas observed across composite PMI statistics across all the major economies in the world, you have, most major economies in the world are seeing their liquidity proxies accelerate on a trend basis as well. And, their liquidity process is just their own central bank balance sheet, plus their own broader money supply, plus their own FX reserves minus gold. We amalgamate all those major economies into our global liquidity proxy, but there's a lot of up arrows there as well. So, and it obviously a lot of down arrows in terms of headline and core CPI. So this has been like a very favorable time to take risk as an investor. This is something we called out in real time going back to early November. We've consistently, kind of reiterated that call here. Now, one thing I would say before we wrap up is I do believe this transition to reflation could come in the context of a market correction. One of the things that we wanted to highlight, that we've been highlighting to our clients really over the past couple of weeks, is the elevated risk of a market correction stemming from position. If you think about you think about investing, you need to have a general sense of, what's going to happen in the economy. You need to have a general sense of, okay, how do most investors respond to those types of dynamics in the economy? And then you need to understand how investors are positioned currently, because that's where the market risk is going to apply based on those changes that you forecast in the economy. And right now, if you think about this from a positioning cycle standpoint, if you look at the AI allocation survey, the cash allocation is only in the 17th percentile. It's at the 24th. It's on a median basis. It's in the 24th percentile at these major bull market peaks in the S&P 500. So that suggests that there's some risk of an elevated correction to get investor cash positions probably back up a little bit. If you think about 3-month realized volatility, we use that as a proxy for systematic investor positioning, CTAs, et cetera. We use it. So on an inverse basis, we could argue that CTA positioning is in the 80th percentile, which would suggest that they're overweight stocks, and this implying elevated risk of a correction. And then 3-month implied correlations are in the 0th percentile. Those are on a median basis in the 11th percentile at major bull market peaks in the S&P 500. And so what we know is that if implied correlations are very low, market neutral hedge funds, the main, kind of multi-manager platform shops that tend to dominate equity market turnover, those platform hedge funds are about as grossly exposed to stocks as they can be, because it's such a fantastic environment to take market risk. And we can see that, as a residual of that, in terms of S&P 500 valuations are in the 89th percentile, with daily data going back to the, I don't want to say to the mid 90s in terms of the price to next 12-month earnings ratio. So, kind of, it's not the best time right now today to be, kind of allocating to that risk, but we do believe over the next, let's call it 1 to 2 quarters, perhaps even 3 quarters, but I would argue 1 to 2 is probably the sweet spot in terms of this new reflation regime. We would expect it to be able to survive, until then, until further notice.
Well, Darius, you make it so easy to interview you, because my final question was going to be where's the risk today? Or you mentioned how it's something you identify for your clients. So I was going to ask you, so risk of a correction.
Yeah, I think we're in a correction. I mean, it kind of started with the CPI data and, continue with the PPI data this week. In our opinion, if you think about this correction, the more systematic types of investors, CTAs or market neutral players, whose risk management systems are determining how much gross capital they have or invested up or down. Those kinds of systematic signals have told investors like us at 42 Macro that you needed to be invested, taking a lot of risk in asset markets, really since early November. I think a lot of fundamental investors, particularly those who have been, chugging on bear porn for the past, kind of call it 2 years, they're kind of waking up in response to some of the moves that we've been benefiting from, here at 42 Macro and kind of capitulating to the upside. So we're not so sure that any type of correction that's going to materialize here can be, particularly deep, because we still see, just anecdotal evidence of a lot of investors still very much on the sideline. If you look at we aggregate non-commercial net length as a percent of total open interest across all the equity futures and options contracts that the CFTC, Commitment of Traders Report, keeps track of. And when you amalgamate that reading is only in the 29th percentile of the historical time series, with data going back to the mid-90s. It's on a median basis at these major bull market peaks, it's in the 62nd percentile. So, and oh, by the way, we're up to the 29th percentile. So, investors have been, kicking, the fundamentalists of the world, the discretionary type investors, the investors who've been drowning in bear porn for, better part of 2 years. Those investors are still not allocated the way they probably should be to take advantage of a no recession, to take advantage of, obviously immaculate disinflation, to take advantage of a Fed pivot to rate cuts, to take advantage of all this good stuff. We're just arguing that, this is still a good time to take advantage of that. But if you roll the clock forward, let's call it 1 to 2 quarters, I got to imagine that, our models are suggesting that inflation is probably going to start to rear its ugly head in a more broad and obvious way that may actually cause, the Larry Summers of the world to actually be right, to cause investors to think about more two-sided policy risks. So in our opinion, that's something we're going to have to deal with as investors. I think we're going to have to deal with an inflection negative in global and U.S. liquidity sometime in and around mid-year as well. So I think it could be a tale of two halves if you think about investing for 2024. But again, I don't think we need to make that call today. The call we need to make today is we're pivoting to reflation. There's risk of a correction. You buy the dip and reflation type exposures in that correction, because we ultimately see reflation having sustainability over the next 1 to 2 quarters. Check back with us a few months from now to get that update.
Well, we'll definitely want to check back with you. You're always a hit. Darius, I want to give you the last few minutes. Let folks know where they can, find your work and subscribe to your work, support your work. Anything else that you want to plug, any parting thoughts, the floor is yours.
I appreciate you, Julia. Like I said, always love coming on. You are a phenomenal interviewer, because I think a lot of interviews, there's 3 types of interviewers. There's very prepared interviewers like yourself. There's very prepared interviewers who want to hear themselves talk, and then there's just underprepared interviewers. So I would consider you certainly in that first category, which I always appreciate interacting with. But just kind of generally speaking, I don't obviously do these things for poopy giggles. It's to grow the notoriety and the brand of our business, because I think we're doing a lot of great work for investors all across the sophistication spectrum here at 42 Macro. If you like making and saving money on a consistent basis, 42 Macro is the shop for you. It's not saying we're always going to make money or we're always going to save money, but 2 things we can promise you is that you're going to be more equipped to do those things consistently than you would be otherwise listening to more discretionary style, investment processes and procedures. And 2, this is top end institutional, high top quality research. This is where I cut my teeth on the global buy side. Meeting with all these the PMs and CIOs and asset allocators across the global buy side. So a lot of what you see in 42 Macro research are things that, elements of the processes that I've mimicked and taken from those folks, because I understand what actually works to help investors make and save money on a consistent basis in asset markets. Again, as we started this discussion, you don't have to stay on the right side of market risk if you're a retail investor. You definitely do if you're a buy side investor and want to remain employed and want to be able to continue paying your mortgage and taking your wife and her husband on dates. But if you're a retail investor and you also like staying on the right side of market risk, like having profitable trades, like risk managing unprofitable trades faster rather than sooner rather than later, then our research is the kind of top end macro risk management research for you.
Darius Dale, founder and CEO of 42 Macro. Thank you so much for being so generous with all your time and knowledge and charts. They're always fantastic to see, and great to see you as always, Darius. Really appreciate you taking the time.
Likewise, Julia, I appreciate you, and best of luck. I'm loving the growth of your brand and firm as well. You've been doing a lot of great work, so keep it up.
Thank you so much. Likewise.